Over the course of the last 12 months, we've seen the United States yield curve steepen. This is when the yield curve comes out from what's called an inversion when it is below 0%. And as we've covered many times before on this channel, this is a notorious recessionary signal. The yield curve steepened in late 2007, right before the beginning of the Great Financial Crisis, in early 2001, right before the dot-com bust. And we have many more examples of yield curve steepenings that were subsequently followed by US economic recessions. And this, by the way, includes the steepening that occurred just a few months before the onset of the Great Depression in the 1930s. The only problem is, in the vast majority of these examples, a recession began within 12 months of the yield curve steepening. And yet today, the yield curve steepening began in mid-2024 has not, as of the making of this video, been followed by a recession. Real GDP growth in the United States remains at a very solid 2% per year, and the unemployment rate is currently sitting at 4.2%, which is within the range of what the Federal Reserve considers to be full employment. And just in case you don't trust the US government's numbers, just look at the stock market. It's sitting just a few percentage points below its all-time high. Not exactly something you would expect to see if we were actually experiencing a recession. Now, some of you might be thinking to yourselves that perhaps we're just around the corner of seeing all of these data points begin to turn in the opposite direction, that GDP growth is about to decline severely, unemployment rate is about to rise, and the stock market is about to fall. But the rest of you are thinking that perhaps it's finally time to conclude that the yield curve has failed as a recession signal this time around. We'll try and provide a clear answer to that in this video, and in order to do that, we first need to look at why the yield curve works so well as a predictor of economic downturns. When the yield curve is inverted, it means that short-term interest rates are above long-term interest rates. This is something that is primarily influenced by the Federal Reserve that can adjust short-term interest rates as they wish. What's also known as the federal funds rate. And when they raise interest rates enough to invert the yield curve, it sets off a chain reaction that eventually causes a recession to occur. Most of this chain reaction simply comes from the fact that credit conditions are tighter when the yield curve is inverted, which means that banks limit lending to people and businesses, which slows the economy down and eventually can cause a downturn. As we'll take a look at in a second, this chain reaction typically takes about 12 months to take place. The very opposite is true when the yield curve is steep, or in other words, at elevated levels. This is when short-term interest rates are much below long-term interest rates, which provides an environment that is good for growth. Credit conditions are loose, which means banks are lending money quite easily, which provides the right conditions for the economy to grow looking forward. So that's how the yield curve works in theory. But what does it look like in practice? Take this line here that shows us whether the US economy is growing or contracting at any given point. When this line is above zero, the US economy is growing. When it's below zero, the economy is contracting and is in a recession. As you can see, we're currently sitting at about a 2% economic growth today. Now, let's add the yield curve on top, but here we've actually made it so that the yield curve has been shifted forward by 12 months relative to the line showing us economic growth. And when we do this, we can see that the two lines match each other almost perfectly. Let's do a quick sketch to make sure that we're being very clear regarding how this works. When the yield curve goes up or down, that is followed 12 months later by a corresponding move up or down in the economy. And so when we shift forward the yield curve, the two lines match each other very closely. But most importantly, the yield curve helps us predict what the economy is going to do over the next 12 months. You can quickly understand here why the yield curve is considered to be such a powerful macroeconomic indicator. There is just nothing else like it. But like any indicator, it isn't perfect. Just looking at this chart, we can quickly notice that there are some moments where a yield curve inversion did not lead to a contraction in economic growth. But in the vast majority of cases, when the yield curve inverted, within the next 12 months, you saw a recession materialize. Today, we have had an inverted yield curve since late 2022, and despite this, the economy has held up so far very well. But as you can see, we are still in the danger zone right now. Exactly 12 months ago, the yield curve was still inverted, which could mean that the economy continues to be vulnerable to slowing down over the next few months. It wasn't until October of 2024 where the yield curve began to steepen and come out of its inversion. So that means that until October of 2025, we are still in the zone where the yield curve signal could still come to fruition and accurately forecast an economic downturn. So that's roughly another 5 months before we'll know absolutely for sure whether this yield curve signal that we've had has completely failed or not to predict a recession. So this naturally brings in the question of whether we should expect a recession to occur within the next 5 months. And in order to answer that question, we have to understand why the economy has so far been able to avoid a recession despite the yield curve having been inverted. The first reason is that the US has had a very tight job market. Job openings in late 2022, which was the moment when the yield curve initially inverted, were at much higher levels than anything we had previously seen over the last 20 years. So you had massive levels of hiring happening at the time, which is a very different look to what the number of job openings looked like right before the 2008 recession or right before the 2001 recession. In both of these cases, the job market was a lot weaker, and the yield curve inversion simply pushed the economy over the edge and into a recession. Now, since 2022, we've seen the job market weaken considerably. The number of job openings has dropped by 30% since. So we're definitely no longer in the same situation today, and arguably looking at this data, the economy is more vulnerable to dipping into a recession today than it was a couple of years ago. Overall, however, the job market is still in a better shape than it was pre-pandemic. So we're not in a catastrophic situation either. The second reason the economy has been able to avoid a recession is that corporate profit margins have been extremely high in the US. In fact, they've been at the highest levels in recorded history, which isn't what you typically see before a recession happens. What typically happens heading into a downturn is that for reasons X, Y, or Z, businesses see their profit margins contracting, and as corporations see that happening, they naturally seek to cut costs, which in other words means laying employees off. And that is one of the defining characteristics of a recession. When you look at corporate profit margins throughout history and highlight all of the recessions that have occurred, we do see that in the vast majority of cases, you have corporate profit margins that decline before the recession starts. Now, the actual reason for why corporate profit margins decline varies case by case. In the 1970s, oil shocks and rising interest rates very much contributed to declining corporate profits. In 1999, the tech bubble bursting was likely the key catalyst that brought corporate profit margins down. In 2006, the combination of the housing bubble bursting and oil prices rising aggressively were likely responsible for the decline in profit margins that preceded the Great Recession. Today, we haven't seen corporate profit margins declining, however. Now, we could say that profits peaked in late 2023, but overall they've remained quite elevated since. Now, we've argued that Donald Trump's tariffs could potentially drag down profit margins, which could eventually bring about a recession. But for now, corporate profits remain sky high, which could, in our opinion, provide some more dry powder for the economy to avoid a recession over the next 5 months, as businesses really don't need to be cutting costs right now. Now, I want to be clear, we could be completely wrong about this. And this is what trading is all about. It's about weighing the odds of certain things happening and placing bets on them, all while managing our risk in the event that we're wrong about these things happening. Right now, we have positioned ourselves to take advantage of a resumption of the bull market on stocks heading into the end of 2025, as we do expect the economy to hold up. It's entirely possible that we need to adapt this position if the data changes. If you want to follow all of our decisions, our entire strategy in real time, make sure you're subscribed to our membership at bravosresearch.com. We teach you how to trade macro, how to pick great trade setups. We give you the buy and sell alerts for all of our positions and provide market analysis multiple times a week. You can click the link down below to check it out. Thank you for watching.